Okay, the last bit for this module, which is just continuing to scratch the surface of the topic of stocks. We went through some detail about bonds, and we went through how bonds are priced. And, there's a lot of differences between stocks and bonds as financial instruments, right? A stock is actually a share of ownership in a company. A bond is a loan. And so because a bond is effectively buying a known cash flow stream, bonds are straightforward to price. You just discount the future cash flows. Well, stocks are like totally different. This chapter in your book kind of goes through some of the basics of stocks, and it also gets into it kind of like it tries to do stock valuation sort of analogously to the way that we did bond valuation in the prior chapter. And this pricing model that they provide, they actually tell you how to price stocks using a couple of different varieties of a dividend pricing model, and then they go ahead and say, but the model's no good. Right? So we're actually not going to pay attention to the dividend pricing model. But I did just kind of want to go through some basics of stocks so that when we get into the capital asset pricing model, which is fairly technical, you'll at least have some of that background knowledge going into it. The other thing I did want to hit on a little bit is this idea of market efficiency, because that, again, is another thing that's up for discussion. And if you take the financial economics class over in the economics department, you will get a lot of education about the challenges around the efficient market hypothesis. Okay, so back to the basics. What actually is common stock? Stock signifies a share of the ownership in the company. As a matter of fact, that's what you buy. You buy a share of stock, right? So when you own common stock, that means that you have a share of the ownership of the company. That means that you have a right to participate in the management of the company. Of course, usually shareholders operate through the board of directors, which sort of provides oversight to the day-to-day management of a company. But there are some businesses which have very famous shareholder meetings, including Berkshire Hathaway, which has an annual shareholder meeting in Omaha. And I happened to live in Omaha for a little while, and that was quite something when they have that shareholders meeting, because Buffett is one of the world's wealthiest people, and especially was 20 years ago, and he lives in this very modest house, right? And he's sort of famous for living in a modest house. It happened to be 5 houses away from mine. And so people would be like driving around all over Omaha when they went to the shareholders meeting, looking for Buffett's house. Another shareholder meeting I went to years and years ago was a Ben & Jerry's shareholders meeting, which was held at Stowe, the ski resort, in the summertime. And it was just a tie-dye wearing, ice cream social. It was very, very fun. So, when you have a shareholder, you get to participate in the management of the company. And then, if a company goes belly up, their shareholders would get paid out of the value of the assets after all the debts had been paid. The other thing is that when common stock is issued, it never goes away. Now, the thing is that some of the value of investing in stock, right? There's 2 different benefits that you can get if you invest in a share of stock. One would be the potential increase in the value of that stock on the public markets. So if you buy a stock for $10 and it's worth $120 now, right? Then you've made a profit there. But the other thing is that people invest in stocks for the purpose of dividends. So that is how your portfolio, your stock portfolio, can become a cash flow generator, right? You get dividends from some companies issue dividends. Not all do. Now, the Securities and Exchange Commission authorizes companies to issue shares of stocks, and then not all of the shares of stocks are available for public trading. The ones that are actually out there in the public domain are considered to be stock outstanding. Right? So sometimes you'll have like this major issue of stock, but the company won't actually go out and put them all out there in the market. They'll hold some back. Or sometimes they're given as compensation to employees or managers. And sometimes, as a matter of fact, companies can keep their own stock internally. That's called treasury stock. And then the last issue that they talk about with stock is related to this idea of dilution, which they don't actually mention. So imagine if we go back to this question of early stage financing for a startup company that I talked about with regard to Chapter 15. So let's say you're a startup company and you invest $10,000 of your own money, and you own 100% of that company. And then you get another $10,000 in investment from someone else. Well, now you don't own 100% of the company anymore, right? How much of your company do you give up to your investors when they invest with you? Or can you make it so that one of your early investors can always have the first opportunity to continue investing such that they maintain their percentage ownership? That's what's called a preemptive right. And again, this question of dilution and ownership shares and how much a company is worth, which implies how much the investment should get in terms of a percentage of the company, that is a sort of an upper level finance thing. If you're interested in it, let me know. I can work it through with you, do an independent study or maybe an upper level class or something. But the question of ownership shares and how much the value of your investment is becomes really, the difference in millions of dollars in difference for startups, for entrepreneurs, and for early stage investors. So that was just sort of a glossary of some terms, right? The next section discusses markets. Right, so really, when you talk about a primary market, what you're talking about is the initial public offering. Right, so the process of selling stock begins with an initial public offering, and this section goes into like how you hire an investment banker. It's strange the way this textbook is laid out. But the bottom line is what you need to know is that a stock is first issued through a primary market through an initial public offering with the help of an investment banking firm, and then once it's been offered once, then it starts trading in the secondary market, in the stock market. And there are a few different stock markets actually. There's the New York Stock Exchange. There's NASDAQ, or the National Association of Securities Dealers. These are the two major ones. Amex got swallowed up by New York Stock Exchange. And so here's the New York Stock Exchange website. And you'll notice that it's not what you think of as a stock exchange website, right? There's no running ticker up here about what the value of the market is today. This is really an informational website. If we wanted to look at sort of the stock status of the day, you'd go to something like Yahoo Finance or something like that. Probably Google Finance has the same thing. And you can see where these major stock indexes are for the day. Now, S&P, we're back to Standard & Poor's. They not only provide bond rating services, but they also have a S&P 500 index of major industrials. This is the Dow Jones Industrial index as well, and the sort of overall value of that bucket of stocks. NASDAQ is started as this sort of boutique-y little organization that was tracking like startup, .com companies in the 80s and 90s, and has since grown into, of course, a major, that's become a very major component of the economy. So that's sort of a brief overview of stock markets. Again, huge topic, not something I want to go into in a lot of detail right now. The other little tidbit in this chapter is this question of bulls and bears. So a bull market, these are just terms that have evolved over time. I don't know that anybody actually knows the history of where these terms came from, but a bull market implies that there's been strong growth in the overall price of the equities on the markets, and that it's that it's expected to continue to increase. And a bear market is a prolonged declining market. So that's what those are. So the next section aligns the value of a stock to the history of its dividend payments. Because remember, with a bond, you know what that coupon payment is going to be. With a stock, not only do you not know what the dividends are going to be, I mean, a lot of companies do try to be really consistent with their dividends, but you don't know what the ending price of the stock is going to be, what the future value is going to be. So these stock valuation models are of extremely limited utility. So I'm actually not even going to address them with you for this class, because, as I said, next module we'll be going into more detail about a more robust valuation model. And as a matter of fact, there's a section in your textbook which explains what the shortcomings are. The last little bit I want to hit in this section is this question of efficient markets. And by efficiency in this context, we mean that there's minimal friction in the market, that trades occur smoothly, and that the prices are right. And the prices being right means that the price of the stock includes all relevant information. Now, you cannot argue with the operational efficiency of a stock market. Those people have the best computer trading systems you can possibly imagine. They are operationally efficient. The question is, are they informationally efficient? Right? So as information becomes available, is all of it baked into the price of a stock instantaneously? Okay, do all players in the market have all required information about the likely future cash flows associated with that stock? And if they do, then that will be instantaneously reflected in the price of the stock on the market, in the secondary market. And they get into a few different sort of flavors of informational efficiency. In what they call a weak form efficient market, the current stock prices reflect the stock's history and trading volume. What that implies is that none of us can look backwards and try to predict the future cash flows based on the cash flows from the past any better than the market already does. And then on the other end of the spectrum, strong form efficient markets imply that all of the weak form efficient criteria are met, that is, that the price of the stock has baked in all the historical facts that are available, as well as all the publicly available information that's out there today, and that the current prices even reflect private information, meaning that, you know, when managers of a company know something is coming, that the market knows that too, even if it's not available in the press. Then sort of in between is this semi-strong form efficient market, which implies that the current prices of securities in the secondary market reflect the price history and all publicly available information. So when a news story comes out about one thing or another, it is instantaneously baked into the prices that people are trading at. So the strong form efficient markets hypothesis, this idea that markets have access to not only publicly available information but also privately available information, is not realistic, right? There are insiders and people that know things that are not publicly available, and so the strong form efficient market hypothesis is rejected. Academic research has pretty well supported the semi-strong form more so than the weak form or the strong form. So what that means, though, here's this, right? This is the thing. Are markets efficient at the weak or the semi-strong version? Most academic research supports markets as semi-strong efficient. In fact, markets fully reflect public information within minutes, leaving little opportunity for exploiting this information to make sizable gains. Okay, that means that, for someone to try to make a living day trading or beating the market or best guessing the market, very unlikely. Because the market has so many players, so many people with access to so much information that you or I could not possibly exploit, publicly available information any faster than the market itself can. Okay. And so that's all I really have to say about stocks at this moment. We are going to talk in great detail about, some issues around pricing stocks and how markets work and what risk means in terms of stocks. But this was just a very, very, very brief and high-level overview of stocks and the stock markets. Okay, so that's the end of what I've got for this module. Again, most of your homework is conceptual rather than quantitative, except for some bond valuation stuff. But this was just like a ton of information all at once. Definitely reach out if you have any questions, and we'll move on to the next unit quickly, and probably as we go through the material in the next module, some of this stuff will make a lot more sense as well.